Today, using ValueLine's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have a lot of time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on valueline.com and our YouTube channel within the next 48 hours. Lastly, as an added bonus, attendees will have the opportunity to receive an additional stock recommendation. I will provide details at the end. To start, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers, and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As a jumping-off point for our stock search, let's start with an overview of the economic situation, as well as the ValueLine Research Department's view of the stock market. This is especially important since the market has been quite volatile of late, and investor trepidation stemming from a variety of issues are still present. The following content was prepared by Harvey Katz, ValueLine's chief economist. The nation's economy really stepped it up earlier this year as the near-decade-long expansion, heretofore an understated affair, came on strongly during the spring and summer. In all, GDP growth, which had been averaging a pedestrian 1.5% to 2.5% for much of this decade, increased by 4.2% and 3.5% respectively in the second and third quarters. That mid-year push is being followed by a rather solid final 3 months, in which most consumer and industrial sectors continue to do well. This should lift growth to near 3% for the full 12 months. The good times have been led by consumers, who, bolstered by fatter paychecks, bright job prospects, and generally rising home prices, have opened their wallets wider this year. In truth, though, it is more than the consumer. The upturn has also been supported by a rise in government spending, and at least early in 2018, by strength in non-residential fixed investment. Also helping have been healthy increases in employment and a 50-year low in the jobless rate. Steady gains in manufacturing and non-manufacturing, growing income streams, and multi-decade highs in consumer confidence also are underpinning the above-trend GDP growth. All's well that ends well, at least as far as the economy is concerned. We are seeing high levels of manufacturing and non-manufacturing, a rebound in retail sales, and a slight pickup in housing starts in October after a sharp drop in September. To be sure, the gains aren't uniform, as our growing trade deficit affirms, with the imposition of new tariffs in Europe and China hampering our export business. At the same time, rising mortgage rates, as part of an overall tightening by the Federal Reserve, are keeping a lid on housing activity. So, while fourth quarter GDP growth may surpass the 2010 to 2017 range of 1.5% to 2.5%, it could fall short of the mid-2018 gains. The beat is likely to go on in 2019, but at a gradually moderating pace, driven into this more deliberate lane by rising interest rates and higher tariffs, particularly if trade talks with China fail to bring results. Further, If a stock market fails to recover, that could dampen consumer confidence. Add in higher interest rates, especially charges on mortgages and auto loans, the likely raise in inflation from higher priced imports, and the strong dollar, which will make our exports even less competitive, and GDP growth may edge a bit lower in 2019, bringing the prospective increase in growth into the 2.8% range. But that still would be above the top of the earlier multi-year band. The long-standing beneficiaries of this cumulative good news on the economic and earnings fronts have been investors who have participated in this historic bull market that has seen the Dow Jones Industrial Average more than quadruple since its 2009 lows. The other indexes have performed similarly, if not better. However, the last 3 months have been problematic. Specifically, after a surge through late September, stocks have retreated with a few breaks in between. Several indexes, in fact, suffered a correction earlier this fall before rebounding briefly and then falling anew. Key factors in this October-November slide have been worries about global trade, the slowdown in Europe and parts of Asia, political turmoil in the United Kingdom over efforts to save Brexit, fears the Fed might step too hard on the monetary brakes, and the uncertainties over prospects of divided government in Washington. How well this all plays out will be decisive in gauging whether this historic bull market will be sustained further. Given the compelling fundamentals still in place, our senses of the street can handle such headwinds. That said, the road ahead could be bumpy, and the recent step up in market volatility figures to be a harbinger of things to come. In conclusion, these clearly are challenging times for investors, and as such, careful stock selection with an emphasis on quality will be most important. Should such care be taken, and assuming fiscal and monetary policies are constructive, the bull market should stay in place for a while longer, although, as recent troubling activity suggests, we may well see less assured returns going forward. I personally agree with Harvey's assessment, and I'm going to use details of his views in our search today for one stock to buy right now. Thankfully, Value Line provides the tools and information to incorporate factors such as these into an investment strategy, which we will tackle in a few moments. For now, however, please note that we are currently on our homepage, www.valueline.com. On this page, you can access free of charge daily market commentaries and analysis, as well as general interest articles that are written by our research team. Examples of such content are analysis of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. On that note, third quarter earnings season wrapped up last week, and you can access these reports anytime from our archive. I'm now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to the many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our home pages for our monthly stock selection services, as well as our investment tools. As you know, the point of this presentation is to find a stock to buy right now, so let's go to the screener and get started. This tool can also be found via the Find Ideas tab at the top. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. I am now going to run a screen with the information we've discussed, as well as add some other worthwhile variables. The goal will be to find the most stable equities that are expected to hold up relatively well if the market falls further, but also benefit significantly if the bull market gets back on track. Obviously, let's start with stability. Personally, whenever I'm conducting a stock search, I always prefer to remove risky equities, and there are numerous risk and volatility measures, but we recommend Value Line's proprietary safety ranks. The safety ranks measure the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. This should be particularly relevant in today's market environment. So let's focus on stocks ranked 1. So I simply click on the field and click on 1. These are the most financially sound companies, and their stocks have a history of relative stability. It is worth noting that of the nearly 6,000 stocks in our database, only 130 or so garner this top rank. For those that don't know, our safety ranks are derived from our financial strength grades and our price stability scores. For more information here, I recommend a read of our ranking system guide, which can be accessed via the investment education section on our site, via this tab. On top of safety, we can add another defensive layer by considering dividend yields. As most of you probably know, dividend-paying stocks tend to not fall as much as the broader market during bearish times. The current median dividend yield for the 1,700 stocks that we track in the Value Line Investment Survey is 2.2%. This figure is updated and published every week on the front cover of our summary and index. For added stability, let's make 3% our low threshold. I also want to mention that this yield encompasses our research department's estimates for the next 4 quarters of dividend payments. Thus, this is very much a forward-looking yield. This is an important distinction since other research houses, screeners, portfolio software, and data providers commonly utilize a trailing dividend yield. We feel that our calculation is simply more useful. Click on Filter, and we're already down to 35 candidates. Now let's focus on performance. I want to isolate stocks that Value Line expects to outperform the broader market over the near and long terms. For the short term, I'm going to use our popular and time-tested timeless ranks. Like safety, the ranks are from 1 to 5, with 1 being our top rank. 1s and 2s are expected to outperform the market over the next 6 to 12 months. 3s will likely mirror the market, while 4s and 5s may lag. A great deal of information on the ranking system for timeless is available in our guide, but I should mention that although the calculation is purely quantitative and proprietary, the system is based on a number of factors including earnings results and stock price action. So let's add timeliness to our screen. And as mentioned, we're only going to focus on the 1s and the 2s. Okay, down to 15 results. We're getting close. My last field will focus on potential stock price appreciation over the long term. This is a good time to mention that for all 1,700 stocks in the Value Line Investment Survey universe, we create 3 to 5 year financial projections. I want to highlight that Value Line is one of very few research houses that provide financial projections that far out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. Using these values, we then create a target price range for each equity. For the final field, I want to tap into this and include the projected 3 to 5 year annual total return percentage, and I'm going to focus on the low end of the range to be conservative. I'm going to use 10% as my starting point, which is higher than the historical annual rate of return for the major stock market indexes going back decades. For this, I have to type 0.10 into the front box. Just 4 results. According to our criteria, these stocks are the safest, offer worthwhile dividends, and are expected to perform well over the near and long term. A few of these may well fit nicely in your portfolio, depending on your time horizon and strategy. Before I go any further, I want to call out Verizon. I recommended this telecom behemoth at the webinar I hosted last month on October 24th. Since then, the stock price has advanced almost 7%. For comparison, the Dow and S&P 500 index are down about 1%. I'm still recommending VZ, and I encourage you to watch last month's webinar for my investment thesis. It is posted on our YouTube channel. For today, however, the one stock to buy right now is Exxon Mobil, ticker XOM. This may seem surprising to some, since the energy sector has struggled of late, but while preparing this presentation, I discussed the sector's current prospects and future with a number of my senior analysts. While there are certainly concerns, Exxon appears to be in an advantageous position, and we think that investors will be rewarded over time. Before I dive into Exxon, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden so you can create your own customized stock report. For instance, if I want to have the commentary at the top, you can simply drag it. If you want to make it bigger, I got to move the ranks down. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to this stock, it will look the way I set it up. I can also apply these changes to other equities. I assume you are all familiar with Exxon Mobil, but I will provide some details about the company and its scale of operations. This information is provided in the business description module. It is an integrated oil company with daily production that reached 2.3 million barrels a day of oil and 10.2 billion cubic feet of natural gas in 2017. It has more than 71,000 employees with a market cap that exceeds $325 billion, making it one of the largest publicly traded companies on U.S. exchanges. Lastly, and this is just a fun fact, with General Electric's recent exit from the Dow, Exxon is now the longest tenured component of that index. It was added in 1928 and was then known as Standard Oil of New Jersey. As mentioned, the energy sector has struggled of late, and I will provide more details in a moment, but let's first see how the shares of Exxon have performed. From the valuation module, I can quickly pull up a chart, and the yellow line is the stock price. As you can see, for the most part, XOM has traded sideways over the past couple of years. More recently, it has been more of the same, but that has actually been a positive relative to the overall energy sector. More specifically, over the past 3 months, Exxon has sustained a total return of negative 2%. The energy sector's median and average total returns during the same time frame are both more than negative 15%. Simply put, Exxon has fared far better, and I will now get into why using our classic one-page reports, which are available for all digital subscribers. They are available using the button at the top. This report was just published and was prepared by Robert Mikowski, Jr., Associate Research Director. ExxonMobil's ability to think long-term should serve it well over time. The company is taking a more ambitious approach than many of its oil industry brethren by ramping up spending somewhat sooner than others plan to. Part of the reason is that Exxon has had to retrace its steps and get back in on domestic drilling in a big way. That has led to major acquisitions of producing properties in the Permian Basin of Texas and New Mexico. Over and above that, the company probably feels that adding capacity now will pay off down the road, assuming global growth keeps a floor under oil prices. Profits may well boom by 2021-2023 under that scenario. That said, Wall Street has its doubts, particularly coming off the steep oil price slump of a few years earlier. The concern is largely that industry overproduction could hurt oil quotations in a similar manner to the way natural gas prices slipped following the development of shale resources. But the likelihood of less spare capacity in the case of oil ought to give it greater relative value. Investors are also not enamored with the uninspiring oil and gas production trends turned in here lately. The rebuttal is that the company is more focused on profitability than volume. As for our take on the stock, These top-quality shares offer attractive, risk-adjusted potential returns over the 3 to 5 year horizon. Exxon Mobil's ability to deliver higher profits depends on a combination of rising energy demand, driven by global growth, combined with a supportive level of oil prices. Those assumptions, while not completely assured, seem attainable. In the meantime, the shares, ranked 1 for timeliness and safety, provide good income. In fact, the yield easily exceeds 4%, and the payout is well covered. In all, Exxon Mobil, ticker XOM, is one stock to buy right now. Before I move to your questions, I want to quickly highlight one product the Value Line offers that may interest those that found today's strategy for finding stocks appealing. We offer Value Line Select Dividend Income and Growth. It is one of our premier monthly stock selection services that, as the name suggests, recommends stocks that offer worthwhile dividend yields and dividend growth prospects. The recommended equities tend to be large, mature companies that have a history of relative stability, profitable operations, and the financial strength to generously fund dividend payouts. Each month, we publish a detailed report recommending a top selection, as well as 2 alternative stocks for subscribers' consideration. Once we recommend a stock, we continue to analyze it and regularly publish updates until we recommend that our followers sell their positions. Sell recommendations are relayed via email and phone message. This truly is a total investment solution for those investors with an income focus. If that sounds interesting, please call 1-800-VALUE-LINE for more information. This marks the end of the formal presentation, and I will now tackle your questions. Please remember that I will provide information in regard to receiving an additional stock recommendation after the Q&A portion. So just give me a moment to look at the questions. One question we have is specifically towards Exxon Mobil. How will it be affected by more hybrids and electric cars? Will it hurt the stock over the next 5 years? Of course, electric cars don't run on gas, so that is reduced demand in that respect. But I would say the effects would be quite minimal. There just simply aren't that many electric cars to make a difference yet. Far longer term, yeah, I could see that being an issue, but oil is still used in so many industrial capacities that just some more electric cars on the market I don't think is going to move the needle. Excuse me. What is the main difference between timeliness 1s and 2s? I see that 2s outperform 1s from time to time? Sorry, questions are scrolling. So historically speaking, the 1s have outperformed the 2s over the decades. More recently, in a few of the years, the 2s have outperformed the 1s. Whomever asked that question is correct. We mostly recommend that subscribers consider both 1s and 2s. You'll notice in my screen I included both. There's only 400 total stocks that are ranked 1 and 2. So while we think the 1s will be better over the longer term, for an individual search or for consideration, we often lump them together. Can you repeat the name of the income service? Sure. That's Value Line Select, Dividend Income and Growth. Is there a method to get notified when timeliness or safety ranks change on a stock I own? Yes, there is. That is through the Alerts Hub, which why don't we do right now? So under Find Ideas, click on Alerts Hub, and let's add an alert. The alerts are under 3 categories, and there's about 15 total. So if you wanted to change the rank, please alert me for timeliness rank changes. And I want an email. And there it is. And of course, you can repeat it for safety as well. How would you compare Exxon stock to that of its competitors, Chevron and Royal Dutch? There's certainly nothing wrong with those other stocks, and particularly in this climate, as Harvey Katz alluded to, we would recommend going with the biggest and best. That's particularly true as the energy industry overall struggles. I really like Exxon's focus on investment now that should pay off later. Most other companies, even Chevron and Royal Dutch Shell, aren't as motivated. It's one of the reasons why that stock, I think, made the screen today. If you buy a stock like Exxon, would you put a trailing stop on it? If so, what percentage? It really depends on your individual level of risk. For some of our products, just to give you an idea, we have stop losses at around 20%. Be hard to imagine Exxon dropping that much unless you had a real overall market decline. But it's really personal preference. I think a lot of people use 20 by default, though. Can you please explain the relative PE number? Sure. Assuming that's referring to this number here at the top of our reports. It's also on their digital reports. And that's how this individual stock is valued versus the median of all stocks that we cover, all 1,700. So of course, it's always relative to 1. So Exxon Mobil, if you want to look at it, is trading at an 8% discount to our broader universe. I think 16.3 is currently the average for all 1,700 stocks. Here's one question. Do you have any plans to add the ability to include 3 to 5 year projected prices in user portfolios? I'm assuming that refers to the portfolio tracker. I could be wrong. And in that case, I believe that has been discussed in the past, but I'm not a programmer, so I can't answer that question. If climate change is taken seriously globally, use of carbon-based fuels will need to be reduced significantly. Is XOM doing anything with alternative energy sources? Yes, they have a whole division dedicated to green energy or alternative sources, but obviously it's a small part of their business right now. They are very much an oil and gas company. Here's someone who wrote a comment about the electric car debate or question I got earlier. Remember, oil provides key feedstock for plastics and chemicals. So electric will have low impact even when it becomes mainstream. Electric will have low impact. I mean, obviously, to create a lot of those plastics and chemicals, you need oil. So maybe that's what you're saying. I'm sorry, I don't quite understand. All right, what's the next question is, what is the technical rank? As you can see, Exxon Mobil's is 2 currently. This works as the same thing as Thomas and Safety, 1 to 5, 1 being best. And it is for relative performance of the stock. The main difference is how it's calculated. It only looks at recent price action. It looks at 10 different price intervals, a week, a month, 13 weeks, etc., and looks at all that versus the other 1,700 stocks and generates a rank with a formula from it. All right, this is the first webinar I participated in. How often do you host them? I do 1 a month, and they're all in this format, and afterwards they're all posted on our webpage and YouTube. So if you'd like to go back and see others, they are all there. I believe that is all of the questions. thank you for all that participated and asked them. So thank you so much for participating today and coming on, and take care and have a good holiday season.